So they will finish up the valuation. Hopefully they'll finish the valuation from Walmart. So you have everything needed for papers 3 and 4. And then we might get into portfolio management. We'll see. Just a couple of announcements. I got this email on a job opportunity at Frost on the mortgage side. So it's 2 weeks of training. It's on credit, but it's mortgage. So they underwrite ARMs, which is interesting, especially in this environment. There's probably a lot more adjustable rate right now. Most people are probably thinking, now it's not a bad time to put adjustable rate in and wait for rates to fall. So if you have any students who are interested or have questions, they can email me or message me. So they're going to accept a few applicants every 6 months. They're looking for December 23 graduates. It's somewhat of a relationship banking. So relationship banking is a fancy way of saying sales. So it is a sales job eventually, but it's on the commercial side, which is a little more interesting than the retail side. But if you're interested, email me. It's a former student, and I'll forward it on to you. Number 2, we're trying to find students. UTSA has done extremely well in the CFA Research Challenge. It's a tough challenge. It's pretty time consuming. In January, we've had teams almost every year. Last year, we didn't have one. The year before last, we won the entire Southwest region. We beat out everybody. Last round was UTSA versus Rice, and we beat them out, made it to nationals. We haven't made it past nationals, but almost no one makes it past nationals. But it looks great on the resume. It's a lot of time in January. You submit a sell side report, and if you make that one, you go to the competition. You make a presentation. If you win that one, you have to win. If you win that one, you go to nationals. So we have 2 graduate students that are interested. We usually pull our students from my security analysis class because essentially this project is what we do in that class. And we haven't had anyone in that class that wants to participate. I think they're all worn out from the class because it's a really tough class. But it's very similar to what you're doing for papers 3 and 4. So you've got at least 50–60% of it with papers 3 and 4. You can see the company is Blackbaud. I don't know why they feel like they have to pick a Texas company. It's kind of I don't know, but that's a really small company. It's only a $3 billion company, so a really small company. It makes it tough to do the analysis. But I'll be around in January. I'm usually not here in January because we do a Costa Rica trip. We're going to move that back to May. But I'll be around so I can help. I only give 10 hours on the project, but I can give unlimited hours on how to write a sales side report. So I can do all that all I want as long as I don't talk about the company. So if you're interested, email me. It's quite tremendous on the resume. UTSA has gone to nationals 4 times, which is almost more than any other. There's maybe 1 or 2 other schools that have gone that many times. So UT Austin's never been. So we've been really, really competitive. Our first team that went, I thought they were going to win Texas. They were so good. They practiced their presentation their entire drive up to Dallas. And then they got there and they got so nervous. Their first presenter forgot all of their names. And that's the way they started. They were all he was like sweating just horribly. He was so nervous. And then they got a really horrible judge that asked the horrible questions. So you never know. They're stressed about it. But they did make it. Our first team made it to the 2nd round at least. So it's good. It's good practice. And you'll have 2 I don't know the 2 graduate students, so I don't know how they would do, but and then the market today, so we knew CPI was coming out. It came out barely below what it was expected. So it came out at 0 and they're expecting 0.1. And then I think the big number was a 3.2. That came in below expected. All the numbers came in below expected by 0.1. And you might say 0.1 big deal, but the market's looking for any good news on inflation. So the markets today, oh my word. Sorry, all right, so S&P's up 2%. That's a 2 sigma event, right? 1%, so 1 sigma event. That's pretty massive. Tech is up a bunch. So you might think, well, today's a growth day, but it's today a growth day. What on Bucks, what's doing the best today? Large cap, small or mid? Small, value or growth? What is small cap value doing today? It's up 5.3% today. Why is that? Well, small cap value is what? They want strong economy. These are the small companies that are in bad shape. They've done horribly this year. They're still down quite a bit. I've been betting on small cap and mid cap value. They're both up a bunch today. Look at the bonds. That very last one, bonds are up over 1% today. What's the Treasury doing? Y'all know this stuff now, right? You're real comfortable with this. Treasuries, what are they doing? Is that a good rally? 19 basis points. How many times the Treasury moved 19? I emailed my friend of mine runs a bond portfolio at Victory Capital. I said, you better be up today, or if not, you might as well just retire because you're not up to date. There's something wrong with what you're doing. So yeah, this is a massive day. So the 10-year is well below 4.5% again. So what are bond markets saying? They're starting a big debate, not if the Fed's going to cut, but just when. It's going to be June, it's going to be September, and then how many times, how fast. If you look historically at the Fed, it looks so predictable. Shoots up, it's level, shoots down. It's every single time. But what has the Fed been saying? Going to stay higher longer. What does that mean? Is that going to be different than the past? Who knows? I think a 3% inflation is a pretty decent number. I don't know why they're so fixated on 2%. The Economist had a really good article on that. But they asked the question, psychologically, what's the most important number? Because inflation is a psychological number. Really important. I think we've talked about this. If people are worried about inflation, what do? They buy stuff because they think prices are going up, which does what? Causes prices to go up. If they're worried about prices falling, what do? They put off purchases, thinking prices are going to fall. And what happens? Prices fall. But the question is, at what point in inflation does that happen? The Economist said around 4%. When inflation hits 4, that's when people make decisions. At 3, they don't care. Or 2, they don't care. But at 4%, people start buying stuff faster because they're worried about prices rising. So the Fed probably could get comfortable with the 3%. But Jerome Powell's not going to say that, right? Right now, he's all about credibility. So he's going to stick with that 2, no matter how stupid of a number it is, because he's more worried about credibility. He's not going to be the 1970 Fed chairman that caused the whole thing to fall apart. All right. So let's look at our valuation of Walmart. So we got our discount rate around 7%. So now we're going to do valuation, which is the team exercise on Thursday. So to do that, we need a dividend 0, or we need a free cash flow 0. I'll show you that. We need EPS 0. Obviously, we need the KE. We need a long-term growth. We need a short-term growth. We need the H, and we need inflation. All right, we need all of those numbers. We already got inflation, though, didn't we? We did that in paper 3. Remember that? We're coming up. How fast the economy going to grow? Productivity, labor, inflation. So we already got that number. No reason to have another number, is there? So you already have that. Dividend 0. Where do we get that? Yahoo Finance. But make sure when you do Yahoo Finance, it's not this dividend number. That term 4 doesn't even make sense. So you got to go to historical data, type dividends, and then the dividend 1 is just the last 12 months dividend, right? Dividend 0 is the last 12 months. So 57 cents times 3 plus 56 cents. Yeah, I typed something wrong and say that doesn't add up right. So 227, why did Yahoo Finance show 228? They just took the 57 cents times 4. I don't know why they started doing that. They've been doing some bizarre things. Well, what about free cash flow? So think about the theory. If I were in an interview, I would think I'd be talking about this. I think it's really critical. So all of academia says you value stock not on the dividends, but on their free cash flows. So what is a free cash flow? That's the amount they could pay in dividends. They could buy their stock back. They could pay down their debt. That's the cash flow they have available they can give to investors. We're assuming with the dividend discount model that is dividends. That Walmart is paying out all of their free cash flow in dividends, but that's probably not true for most companies. It may be true for some. So free cash flow, I'll give you a really simple free cash flow formula, really simple. I'd like to take cash from operations less CapEx. That gives you free cash flow to equity. Then you take the number of out shares, and that gives you free cash flow to equity per share. So some of y'all have asked about doing stocks that aren't paying dividends. So if you wanted to do Google or Alphabet, you could substitute free cash flow per share for the dividend. And this is how you would calculate. I don't like this formula. If you read my free cash flow blog, I talk about why I don't like it, but if you need a quick, simple, dirty number, that one works fine. Bloomberg will give you a free cash flow per share, but you're stuck with whatever their formula they're using. It's real similar to this formula. If you take Haddock Ackerman's class, which I highly recommend, he goes a lot more detail in free cash flow and exactly how he calculated all the theories behind it. So it's an important number. So we can go get this for Walmart. All you got to do is go to financials, the cash flow statement. I wouldn't use the TTM. I would actually use the last year. So operating cash flow is 29,101,000,000. CapEx is not called CapEx, but if you look under investing, it's this net PPE purchases and sales. It's the net, and that's 16,687. All right, so there's my free cash flow to equity. Now, if that's a negative number and they don't pay dividends, you can't value that stock. So you're stuck. So I was looking at like the firm for the CFR Research Challenge, and all of its numbers are negative. So it's probably not, you could like, hey, maybe do that challenge. I'll go and value the stock, but that one would be a little tough. Number of shares outstanding. This you get from the cash flow statement. It's under investing, the net PPE, and this you get from the income statement. Oh, sorry. So go to the income statement. And they show you somewhere. Diluted average shares, 2734. So you take that divided by the number of shares, and that gives you their free cash flow per share. Much higher than their dividends. You can kind of tell their dividends is not free cash flow because it just goes up a penny every year. Has no relationship whatsoever to their net income goes up and down, and their dividend just is just stable a penny or 4 pennies every year higher. So I'm going to go with that. The other thing to be careful here is, do you normalize that? And how do you normalize it? The way I do is I will do that like for 3 years and just make sure the latest year is not radically an outlier. Like maybe it was 250, 270, 280, and then suddenly it's 20 cents. Like, okay, something happened this last year. Let me use the median in the last 3 years or something. So you might normalize it. Normalize just means look over several years and just make sure you're not in a really unusual year. Earnings per share 0. That one we can get from Yahoo Finance. This one's Yahoo Finance history. This one's just Yahoo Finance. You can get it right off the summary page. Very simple. Earnings per share. TTM, what does that stand for? Trailing 12 months. That's what we want. I wish they do that for dividends, but they don't. Same thing with PE ratio. The PE ratio trailing 12 months. The price is today, but the earnings is the trailing 12 months. So that's what I mean by TTM. TTM is what we want. That's $5.20. All right, long-term growth. This is where you're just gonna have a discussion, but we talked about how you could do this one. This one is gonna be adjusted paper 3 economics. So on paper 3, we said long-term expected growth was 5.5%. We're talking about Walmart. This is a well-established firm that's pretty saturated throughout the world. So I don't think they're going to grow 5.5%. That'd be a pretty aggressive growth. But if I think the economy or the earnings are going to grow 5.5%, I'm not going to do 2% or 12%. This is a long-term growth. Even Google or Alphabet, you're not going to use 12%. So if you think Alphabet's, well, they got a lot of growth, they're going to be a tech stock always innovating, that's fine, but that means they may grow 6% instead of 5.5%. So you're going to be fairly close to this number. I'm going for Walmart. I'm going to use 4.5%. My 4.5% is just the nature of the business of Walmart. We're pretty saturated in the US, although I'm still amazed how close they put their stores together. You know, if H-E-B builds a new store, what's going to happen next? There's going to be a Walmart across the street somewhere. And H-E-B is fairly saturated, so they're kind of running out of places to build. But 4.5%, I'll use that. Then short-term growth, this is your creative writing. But I also gave you those 3 approaches. Anybody remember the 3 approaches? Takers? You remember the PEG ratio? Sustainable growth and history. Those are the ones that doesn't give you the answer, but it gives you an indication of what it might be. So the PEG ratio, we get the PE ratio, we get the forward PE ratio, we get the PEG ratio, and then expected growth, just the PE ratio divided by the PEG. So the forward PE we can get from the stats in Yahoo Finance. PEG, again, use the latest year, don't use current. The PEG, you can see is 5-year expected. So the PE ratio is the forward PE over expected growth rate over the next 5 years. That's 3.57. That's a pretty high PEG. Oops. The forward PE, we get that also from Yahoo Stats. So PE ratio forward, 2577. So expected growth is just that times that. So 7.22%. That's a pretty aggressive growth rate. Their numbers were a little bit distorted here recently, so there may be something. They came out of COVID really strong. They were really, really strong there when everybody started buying groceries all of a sudden. But it's been a little tricky the last couple of years. So 722 some of that might be coming out of an unusual year. Sustainable growth. Anybody remember that formula? Wait, how did I do that? Whoa. No takers on that. You learned this in 3013. So ROE times retention gives you sustain. So ROE, we can get that from Yahoo Finance stats. We can't actually get retention, but it's 1 minus the payout. Remember that? So your retention is 1 minus how much you pay out. The payouts, your dividends divided by earnings per share. This is another one you might normalize because I'm going to put these in here. So the PEG ratio is 722. So again, you might look at 3 or 4 years on the ROE just to see what number you have. I'm going to pull up a file that I think will help us do this a lot better. So I'm using Capital IQ. If you go to Capital IQ, you don't have to have an account. You don't have to have the Excel add-in, but if you go to the library and get your Capital IQ, you pick your company, and if you go to financials, you can slide the bar to get as much history as you want to, and then you can dump all the financials into Excel, even if you don't have the add-in. So it brings in a lot of data. So if I have Walmart here, here's my Cap IQ data. I can find return on equity in here. There's my return on equity. Y'all see that? My dividends per share, you see that? And my earnings per share is in here somewhere. Oh, it's not gonna let me do it. Thanks, Bill Gates. So let me do each one. It might let, nah, it won't let me do it. So I'll do each one just so I can have it all in this file. Oh, it's probably not gonna let me do it. Ah, I knew I shouldn't have done that. All right, so I've got these historical numbers. So if we look at return on equity, it's pretty volatile. Would you want to normalize that? So it's 12%, 15%, 16%, 18%. There's the 20, the COVID, 9%, 13. 12 looks a little bit low. I could put some medians here. Maybe the last 5 years. So 15 bucks looks like somewhat of a normal return on equity. My earnings per share, so my payout is going to be my dividends per share divided by my earnings per share. The median there, last few years has been 49%, but it has dropped down the last couple of years. So I'm going to go with 15% and 45% in sustainable growth. I get 6.75%. These are all numbers you can get. You can't get these off of Yahoo Finance because you only get 1 year when you do Yahoo Finance. But with Apple IQ, you can bring it all in. So 675 gives us a sustainable growth. And then just looking at history, we can do a 3-year, 5-year, and 10-year growth and earnings per share. So how do you get 3-year? Formula for CAGR. If you're not a CAGR person, make sure you know how to do CAGRs because you're going to do a million of them. So it's just ending over beginning raised to the 1 divided by n minus 1. Here for 3 years, we do the latest year divided by not 3 years prior, but 4 years prior. To get 3 years, you have to have 4 years because you need 3 years of growth. Raise that to the 1 divided by 3. We're probably going to get a really bad number. So where did we start here? Actually pretty good. So it looks like it's almost pre-COVID there. 5 years, exact same thing. You do current year divided by 1, 2, 3, 4, 5, 6. Raise to the 1 divided by 6 minus 1. And then 10 years, This one's probably gonna be the worst looking one, but we'll see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Raised to the 1 divided by 10. It's 1. So you go back 10 years ago, that's right in the middle of the Amazon battle. So they haven't done great since then, but they've done really great the last couple of years, not just because of COVID, but also because they're doing some pretty interesting, exciting things. So Walmart's trying, and this is where I might have my discussion, the creative writing. Walmart's trying to take advantage of the fact they have all these stores. So what is Walmart? If I were writing a paper, I'd find the quote, there's a Walmart within 5 miles of 90-something% of all Americans. Well, that's a pretty good quote, because that gives them a huge advantage in this order online and go pick up. That's a whole new business for them. I've done that with Home Depot. It's not so great with Home Depot because it's like they haven't figured it out yet. So you show up and like, oh wait, what are you doing? And it's like takes 30 minutes to find it. I haven't tried it with Walmart yet, so I might try it. I can't hear you. What? Oh, sorry. Good catch. All right, so I may have, so you have some kind of discussion on the short term. The long term, your only discussion is, I think stocks in general are going to grow at 5.5%. To me, this firm's going to be a little slower than this because of this, or a little faster. It's a little shorter discussion. The short term, you got to go a little bit more into discussion. So, and this is where it's creative writing. Here on history, I'm going to show the 3-year, but you can show any of these numbers. The median of all of these, you can get some pretty radically different numbers. It's around 7%. And then you just got to put a number in there. And it's creative writing, so some justification. So I would probably, with Walmart, focus in on the online presence that they got. I might get some data on their growth overseas. So they're doing really well in Latin America, I can tell, because they own Costa Rica now. It's pretty amazing. In Costa Rica, you walk into a store, it doesn't say Walmart, and you go look at the little sign on the side, and like it's owned by Walmart. So Walmart is everywhere in Costa Rica. I don't know about other countries. I don't know if y'all been in Central and South America, if you notice Walmart a lot. They're not doing so well in Europe. Obviously, they try to get into India. India is a tough place to do retail if you're not an Indian company. Is there a Walmart in China? I would guess probably not. So that's what you're looking for. Walmart hasn't done well in like New York and California, but it's, who knows? Where could you get some growth? 7% is a pretty high growth rate for a firm. The last 10 years has only grown less than 2%, having kept up with inflation. So, what are you going to use? So I'll use 7%, but this is creative writing. You got to just tell me what you believe, what you think. There is another approach you could use, and that's Bloomberg. Use the EE function. You go into Bloomberg, essentially you get analyst expectations in Bloomberg. You just look and see what analysts are thinking. So you can use that. It's very, very similar to the peg ratio approach. It's just a bunch of other people forecasting. So short-term growth is the toughest because there's no place that would get the number. I love it when students say, where do I get my short-term growth? I don't know. You tell me what your firm's going to do next 10 years. I don't know the answer to that. No one knows that answer. I mean, you look at the forecast they did on NVIDIA, pretty bad forecast, wasn't it? NVIDIA just blew them away with the numbers. So, all right, so I'll use 7. And then the H is creative writing on steroids. There, you're just making stuff up. I don't know what you're going to come up with. It's going to be different for every single student and every single company. Just what do you think? So I would probably, with Walmart, talk about well, it's not just growth in revenue. So it's also, I just saw an Economist article that Walmart and some of these others are starting to give up on self-service registers. But are there things they're doing that's going to cut their costs dramatically? So you're thinking what's going on? Robotics is interesting, right? If you've ever done inventory, not the most fun thing in the world to do. It'd be nice to have robots doing inventory. this idea of the new shopping carts where you don't even go through the cash register, but I'm not sure getting rid of all the cashiers saves Walmart a tremendous amount of money. So, those kind of things you're thinking about. There's a lot going on with credit cards and those kind of things. There's a lot of things you could write about. How do you figure those out? I don't know. You read, try to find some way to give some argument. I don't think Walmart has a lot of excessive growth for 10, 20 years. So I'm not going to tell you how come answer. Maybe I'll use 3 there. Who knows? And it's not $3. So I'm assuming it's going to take 6 years to get from 7% back to 4.5%. So my H is 3, half of whatever that is. That's where most students get 0 credit on the H. They don't even attempt creative writing. So have some rationale. You have to have some rationale. You can't just make up a number. So think of something that makes sense. It's not going to be a massive number. If your H is over 5, you're getting pretty aggressive if your short-term growth is a high number. Now, I'm okay on my long-term growth. This number needs to be less than what? Got to be less than my KE. I'm okay there, right? So then it's just a matter of value. So we get dividend discount model, got the H model, we got the cap earnings. Very, very simple models. So dividend discount model, we take dividend 0 times 1 plus long-term growth. This is what you're doing on Thursday, right? Real simple stuff. Divided by KE minus long-term growth. But I'm going to use free cash flow per share. So I'm going to actually use the $4. That gives me 185. All right, so you can use either one, makes a big difference. H model, remember the H model looks exactly the same, except we have this middle section where we do free cash flow. You can use free cash flow in this one as well, times H times short-term growth minus long-term growth. That gives me 198.65. I'm kind of curious if I got that right. So I'm going to take free cash flow 0 times H times short-term growth minus long-term growth divided by KE minus long-term growth. That's what we're adding in on the H, just to make sure. And I recommend you do that on exam, just to double check and make sure you got it right. So that looks right. And in cap earnings, here you use earnings per share times 1 plus inflation divided by KE minus inflation. You can see 116. We expect from most companies that to be a much lower number. That's what Walmart does if they do nothing new. They just stick with what they're doing today. So it gives us a pretty low number. The current price is 167.79. So it looks like about 44% of the current price is new stuff they're going to do that they're not doing currently. So if I think the current value of Walmart and nothing new is 116 bucks, there's another 44% in there for new stuff, new stores, whatever kind of stuff. My valuation is somewhat higher than that. Which of these do you use? Well, you got to talk buy, hold, or sell. And this one, I would probably put a hold in there. What is my upside? 198 divided by 167 minus 1. My upside is only 18%. That's not all that strong of an upside, but I'm looking for like 40, 50, 60% upside. What else could you do? Well, you could get pretty sophisticated. It didn't work, or did it? Can't tell. So let's do the dividend discount model again. So that times 1 plus long-term growth divided by risk-free rate plus market risk premium times beta minus long-term growth. That gives me that 185.35. So I'm going to do a data table. I'm going to use the data table function. I don't like the data table function. We're going to use it anyway. So I'm going to put beta up on top. So what's the highest beta Walmart could have? To me, probably 0.85. And I'm going to go down to say, I think I said 0.4 was kind of the lowest it could be, maybe 0.35. And then over here, I'm going to put growth. What's the lowest growth? Well, maybe 1%. What's the highest it could be? Maybe 5.5. So I'm going to value these. So we're going to do free cash flow. I'm going to anchor that in times 1 plus long-term growth. I'm going to anchor in the column there, divided by the risk-free rate. I got to anchor that in, plus market risk premium times beta, lock in the row, minus long-term growth, lock in the column. If I do that, I forget what my beta was. What was my beta? 0.6. All right, 0.6 and 4.5%. I did something wrong. 0.6, sorry. Here's my 185.35. So I did it correctly, so I can just copy that down, copy it across. But if you do the data table, it will do this for you. So I don't know why it didn't do it. So anyway, so here's my valuation. I'm going to make it nice and pretty. So I now have 110 scenarios for Walmart valuation. How many should you have? So the CFA one that they gave us as an official analysis, they had well over 130 something. It was like 150. They changed discount rates, they changed growth rates. So you have a bunch of them. Then the question is Walmart cheap or expensive? So I'm going to do, if this will work, we'll see if anything happens. I'm going to go back home. I'm going to do conditional formatting. Highlight cells. All right, greater than. All right, so they're currently trading for 160 something. If our valuation is higher than 160, is that good or is that bad? It's trading 160. We think it's worth 180. Do you want that to be green or red? That sounds like green to me. So if it's greater than current stock price, then I want it to be, it's again not working. I want it to be green. Tell you what, I'm just gonna, till Bill Gates leads me along and I have to just memorize it. So it's in C75. So if C75 is, if it's greater than that, then we're going to make it green. And it didn't work again. C75. Still not working. All right, Bill Gates, good job. There's just something bizarre. Every single thing I key in here, it's like it's something's been set up incorrectly. I'll try one more time. It's greater than that. Green looks better. If it's less than that, make it red. What else might you look at? Well, I don't have any negative numbers. I could get a negative number right if my discount rate was less than my growth rate. I'll probably, if I had a negative number, would block it out. If this were like 0.2, I would have a negative number. And so if it's a negative number, what I do is conditional formatting. If it's less than 0, I'm going to do a custom format. I'm going to do a fill that's black and font that is black. So if I get a negative number, I'm going to take that out. All right. I don't want to show a negative number in that spot because that's crazy. Now you might also say, well, that 1135, I don't want to show my boss that. They're going to think I'm crazy to think it's worth that much. So I might say, you know, if it's more than say 400, I want that blacked out as well. So you can make those type of adjustments. And then the question is, what do I think they are? So I have them somewhere kind of in this range. I should have started maybe a little bit higher. So I have them kind of in this range here. So I might highlight a section. So you notice some negative numbers showed up now because I increased my growth rate. So that type of table looks really, really good in a paper like this. You don't have to do that, but it's a lot more interesting to do that. Does that look like a buy, hold, or sell? It looks like a hold to me, doesn't it? It's, you know, 50% of the time I think it's cheap, 50% I think it's real. So it's an interesting approach. So that's something you could do. What else could you do? You could do what's called a football chart. If you've never done one, this would be a good time to practice. I require it in my secure analysis class. Any of y'all done a football chart in here? Did we look at one last class? I can't remember. And I don't know why it's called a football chart. I didn't get one there. Here's one. So you see these a lot. This became popular about 5-6 years ago. I see them all the time. So essentially what it does is you value it 3 or 4 times, you get a range of those values, and you do a chart of that range, and you put the current stock, and you're looking for stocks where the current price is to the left of the range, or on the left side, maybe not to the left, but so it's unlikely you're going to find a stock that's trading below all of your ranges. Your stock price is probably going to go somewhere in the range. But you're looking for stocks that are generally on the left side of the range, so you have more upside and less downside. So essentially what you're asking is, what's my upside, what's my downside? Your downside, your minimum valuation, your upside, your maximum valuation. So you want that upside without the downside. So this is a really good chart to do. They're pretty easy to build. If you're not sure how to build one, just go to YouTube and type stock valuation football chart, and there's like 3-minute, 4-minute videos that show you how to do it. It's pretty simple to do. So none of these are required for the class, but if you're going to put this out on LinkedIn as your paper, it's the kind of stuff you see coming from undergraduate students. It's pretty common approach. If you did the CFA research challenge, they almost all have football charts there. And again, it just suddenly showed up 5 years ago. I suddenly was like, where are these things coming from? You see them all the time. So someone got it started. I don't know who. All right, so there's our model. There's our valuations. I'll put this file out there, but you got to come with your own stuff. Just, so I wouldn't actually use this file. I'd build it from scratch myself, but it's pretty messy, right? I didn't really make it. Someone pulls up a file, they know what to do. It's kind of all over the place. Right. Questions on that? So you have the video of the class that helps you with that. You also have the video. Y'all found the video in our YouTube channel, right? That does the same thing. So you've got everything. And then on Thursday, you're going to do these 3 formulas, real simple formulas. Yeah, I'm always amazed. Students like, are you going to have a formula sheet? Are you kidding me? Is there actually finance majors that don't know those formulas off the top of their heads? I can't imagine. It's like your doctor doesn't know the anatomy. It's like, oh, I have to look it up. I don't know which side of the appendix is on. It's like, no, I'm not going to go to that doctor. So yeah, there's some basic formulas every finance major knows. And those are basic finance formulas. All right, no questions?
In F76, why did you do median instead of mean?
I tend to do median if there's an outlier, and there we had an outlier, the 116.
F76. The percentages.
Oh, same thing. That one, the average probably would have almost been exactly the same. It's not that far off. I just have a habit of doing medians. So if you have a normal distribution, it doesn't matter. But if you have a skewed distribution, the skewed's going to push you real much higher. So like on inflation, you use average inflation. Average is much higher than median because inflation was so high in the 70s. So it gives you a little bit of a skewed number. All right, there's stuff in here I did that you don't have to do. You can do different approach. A lot of students like, I'm just going to do exactly what he said, but that's not good. You got to come your own person, your own analysis. But I'll give you one way that works.
What the table? What was your rationale for stock?
Well, it's when I buy a stock, it's when I think it's 40, 50, 60% undervalued. I mean, undervalued, yeah. So, yeah, I don't like buying. First of all, we have no clue what Walmart's worth. It's this entire range is all of that. There's no complete. Well, maybe the 2% is a little low, but they grew 2% the last 10 years, right? So that's not that radically off. These are long-term growth. So I'm sure not going to use a 7% long-term growth for a Walmart. So that range, $76 to $500, that's certainly possible. If I were doing Alphabet, my range would be much wider. It's a lot harder firm to value. And so given our, remember you're going out 150, 200 years, right? I have no clue what they're going to be doing. So because there's so much uncertainty on valuation, if you're within plus or minus 20%, I think that's well valued. That's kind of close. I'm not going to risk a lot of money for a 20% upside. So yeah, I waited to buy Meta until it hit $90. I didn't have kind of like, it's going to be, and then I got out of it too early. But I had this quite a bit of conviction. This stock really is cheap. And even then I'm wondering, man, why is it so cheap? The market's seeing something I'm not seeing. So it makes me a little bit nervous. All right. So data tables, football charts, those are the kind of things you can do. Just add a little bit more pizzazz to your paper. Might not affect the grade much, but it makes it look a lot better in on LinkedIn. All right. So there's valuation. There's plenty of videos on valuation. Capital IQ has some good valuation models. I do recommend you try the main valuation one because it is a pretty common one, especially if you're going to interview with investment bank. So there's different ways to do it, but the way I just showed you is perfectly acceptable. If you had a new job as an analyst and you just did exactly that, you'd be fine. They wouldn't think there was something wrong with you. So, all right, portfolio management. So let's say you want to do this yourself. You're going to start managing money. First of all, how much money do you need? So stock portfolio, if you can do individual stocks, I think you gotta have at least $100,000. Mainly because, and it's changed a little bit because of Alphabet. Alphabet used to be about a $3,000 stock. You know, if you buy Alphabet, you already got 3% of your portfolio in one stock, so it's hard to diversify. So you want one share or two shares. But now that they've done the stock split, it's not so tough. But you know, you probably could do a $50,000 portfolio, but I think once you get much smaller than that, it just gets really hard to diversify because you know, one big stock. You know, what was Berkshire Hathaway was like a $40,000 stock. You couldn't even buy that stock; it'd be 40% of your portfolio. If you're doing ETFs, it's a lot easier. You can have a $5,000 portfolio and do ETFs because ETFs, you know, you got a lot of diversification already there. So it's just a matter of which market you want to be in. So 100,000. Mutual funds are a little tougher because most mutual funds will have like a $3,000 minimum. So that's a huge advantage of ETFs, right? If it's a $100 ETF, you can buy one ETF. They're brokered subs. So ETFs, you can go much smaller, but generally $100,000. Now, if you're doing a paper portfolio, it doesn't really matter. So, you know, start a paper portfolio, you make it 6 trillion if you want to. It's your money. I mean, your pretend money. So if you know, I recommend you get a brokerage account and do a paper portfolio just so you get in the habit of just trading. But if you're doing real life money, I would suggest you have a little bit more than $1,000. Bond portfolios, if you don't have 50 million bucks, I wouldn't even attempt it. You're going to get crushed on the bid ask bond portfolios. It is not a retail market. It's extremely expensive to trade. A friend of mine, he brought his money to USAA and they set up a separate account for him for 70 million bucks. But I still thought he was kind of wasting his time doing 70 million. But at least he had enough that they could do individual securities for him. So most individual investors, you're better off using bond mutual funds, bank products, life insurance products. I know a lot of small investors do municipal funds, but I just think they're getting ripped off. So bonds, you're probably better off with bonds. Either, you know, you could do Treasury Direct and buy treasuries. Right now, if you're trying to buy CDs, you might as well buy treasuries because treasury rates are higher than CD rates. And treasuries aren't that difficult to purchase. And you can do smaller amounts in treasuries. That's a retail market. If you're doing bank and life insurance products, the reason I look at bank and life is they're really not driven by markets. They're driven by politics and sales goals. So I remember USAA, I bought their EGA. They were paying 6%, or the best you could get anywhere else is like 4%. It's like, why are y'all paying 6%? So I called the actuaries and they said, well, we had a sales goal we weren't meeting. So we increased. I said, that's really stupid, but I'll buy one. They're paying 6% and they're buying bonds making 5%. How much money are you going to make if you're making 5 and you're paying 6? Not make a lot of money doing that, right? And that was 6% tax deferred. It was like, okay, I'll do that. But that was in November because they're trying to hit sales goals. So yeah, that's stupid. It makes no sense. They even said, oh, Ron's buying our EGAs are better. Something's wrong. It's like the credit union, for a credit union, they had a 7% CD. I was on the board. I went to John, their CEO. I said, 7%. We're charging 6% on our car loans. We're not going to make money if we're charging 6 and paying 7. It just made no sense to me. And he said, yeah, but no one's buying them, so we just didn't change the rate. Like, we need to change the rate. That's way too low of a rate. So on the fixed income side, you have several options. You just have to go around and just realize that banks and life insurance companies, they do stuff that's just kind of crazy. You saw that with Goldman Sachs not too long ago. I don't know where they are now, but they needed deposits, so they're offering ridiculously high rates. Yeah, you just go for it. Why not? It's FDIC insured. For stocks, this is the question I always ask in interviews when I was interviewing analysts. Define a good company, define a good stock. If I had someone right out of school, I got horrible answers. Austin, they would work the word team into their answer for some reason. It's like there are no teams in finance, you're all by yourself, but they like
Now, good stock is, as a team, we're gonna go find one, and he's like, none of it has anything to do with finance, but it sounds good. And then I remember the last guy I interviewed before I retired, he had like 10 years of experience. I asked him that question. He pulled out his briefcase and had a stack of paper that big. So let me show you. So what is a good company? A good company has good ratios, good growth, good earnings, good growth prospects, low risk, low debt. That's a good company. Good management. Those are all good companies. What's a good stock? It's a stock that you can buy that's cheaper than the company's worth. That's a good stock. So that's the question I always ask, and it's amazing that I wish I had videos of some of the questions. I still remember interviewing some of my students. I'm like, how can you not? I'm like, when we kicked them under the table, I was like, talk about this in class. How can you not know? So good company, all that stuff you learn in 3013, good turnover, good margins, all those kind of things. That's a good company. You need to have that definition. What is a good definition? I just got an email from GMO today. They're on this quality bent. They want quality companies. And they define what quality is. I would actually, if you're not sure what a good company is, go to GMO and steal their definition. They love quality companies, and they know exactly what they mean by quality. You have to define it yourself, but it can be all kinds of things here. And then a good stock, you got to define how you define that. We just did that with Walmart. A good stock looked like is a decent stock, not a lot of upside, a lot of downside, not a great stock, but looks okay. But what are your valuation metrics? Are you using discounted cash flows? Are you using relative value models? What exactly are you doing to come up with the value for your stock? And we'll talk about relative value here shortly. All right. And then you have to have 4 things: philosophy, process, construction, and risk management. While we're interviewing, that's what I would talk about. I would have my paper portfolio. What is your philosophy? Your philosophy starts with the words, I believe. I believe these type of stocks will beat the market. So that's your philosophy. What kind of philosophies are there out there? There are some philosophies that are based on fundamentals. That's that GMO approach. I believe high quality stocks outperform over the long run. It can be valuation. I want stocks that are cheap on a PE level, or stocks that are cheap on this level. In the investment society, in my security analysis class, we run these models where we actually have ranking models. Define it. Stocks that are cheap versus their fundamentals. Technicals. GMO is real big on momentum. You like momentum stocks. Stocks have good momentum. Momentum is pretty easy. Stocks that are higher today than they were 6 months ago do better than stocks that are lower today than were 6 months ago. That's momentum. It's a piece of cake. Stocks that are up tend to keep going up. There are a lot of thematic investors, top-down ones that are based on their economic models, what they think, versus the stock pickers that are bottom-up investors. What kind of analyst are you? Do you have some major theme, like we think we need to avoid China, we think the rest of Asia is the place to be, we think India is the place to be, we think baby boomers are going to be selling their stocks in these type of markets. We need to make sure, whatever your theme is, you have that theme. If you can back test your philosophy, see if it actually works. If you'd had this philosophy 20 years ago, how would it have worked? And back testing is tough, mainly because when you back test, it might look really good, but it may work really well because the firms you would have bought 20 years ago went out of business and they don't exist. So you can't go back and back test it because their data is not there. So say, hey, wow, this value strategy of buying these beat down stocks, look how great it works. That's because the 50 stocks that went out of business, you don't have them because you can't model that going back. That's called survivorship bias. If you're not sure what philosophy to do, what would you do? If I were you, I would just go out with the most basic one. And that is GARP. Anybody know what GARP is? Any guesses? GARP stands for G. What is G? What is finance law? Growth. What is P? What are you valuing the stock? Price. So growth, price. What's the AR? Growth, at a reasonable price. GARP is the most popular one out there. If I were interviewing for jobs, I would have GARP because that's the most basic one. So what does that mean? I want high quality firms. They're growing, but I don't want to pay too much for them. That's what everybody wants. Where are those stocks sitting around? Oh, look, this company growing really fast, but its stock's really cheap. Why is that? Why would that be the case? Is the market really that stupid? It's like, wow, this is the greatest company in the world, but when it's really, really cheap, no, you're probably missing something. So you can see these definitions. How do I find GARP stocks? I don't know if that link would tell you anything. So yeah, GARP, most basic, but there's other ones. I showed you GMO, it's quality and momentum. With Asness has some philosophies. So, find a philosophy and just steal somebody else's. That's perfectly reasonable. These things aren't, GARP is not copywritten. You can steal GARP if you want to, because everybody does it. GARP's the most popular one out there. It's kind of the most obvious one. Most people aren't going to say, I want really, really cheap stocks that are horrible companies. I kind of do that sometimes, where I find a company that's been beaten down. That's one of my strategies. I list stocks the last 52 weeks from worst performing to best performing. I'm looking at worst performing to see if there's someone. That's why I bought Meta last year. They said, what stocks sold off the most? So that's kind of a bottom fishing type of strategy. So can you test it? And then the next one is process. So you define what stocks you like. Process is how do you find usually some computer model that's going to dump in the information. Bloomberg has a screening model. We build our own models in the investment society. You can watch my videos on how to do that. But how do you find those stocks that meet your philosophy? And what's your universe? In the investment society, we start with the Russell 3000 and try to screen down to like 50, 100 stocks or so. Probably not that many, because we're doing it by sector. So that's the process. I would strongly recommend that you go through that process. We just did it in my security analysis class. You can watch the video from that class. We went through the entire process. The video takes 15 minutes, and that has two models in it. So in 15 minutes, I show them how to build a model. Now we started with an existing model and adopted it, so you'd have to get the model from me. But some way to screen, you can't just say I'm going to go out there and research firms, because you don't have that much time. You're not going to research 3,000 companies. It takes 50 to 100 hours per company. You're not going to research 3,000 companies. So you got to get the computer to get you down to a list that you can handle. And that's what the process is all about. So most people start with the computer and then they have some more hands-on at the end. Construction is just how you're going to put them together. So if you have 100 stocks, you're going to put 1% in every stock. You're going to have some model that says, hey, put more in this stock versus this stock. There are firms, especially some hedge funds, that have these optimization models where they look at trading costs versus the upside, and they do that. There's some that just they kind of look at the market weight and go off of that. Enhanced indexing does that. They say we don't want to be off more than 0.25% of the market weight, or whatever you're going to do. So equal weight actually works pretty well. There's a new approach called fundamental weighting that's about 10 years old. The guy at UTSA started a fundamental weighting ETF, and I don't know how it's doing. I should ask him. But fundamental weighting means you use something on the accounting statements to weight it. So you might use revenue or net income. That's kind of unusual, but people have been doing that. You can Google Robert Arnott. In fact, what I would do is the most interesting way to do this is Arnott versus Asness on fundamental weighting. So these two have been debating that for years. They're both geniuses of finance. They're both really, really good guys. It makes it look like they hate each other, but they actually highly respect each other, and they make fun of each other in blogs and podcasts all the time, because they're both champions of finance, so they can kind of get away with making fun of each other. Asness hates fundamental weighting. He thinks it's value investing. Pretty obvious it's value investing, because obviously if you weight it based on income, low PE stocks are going to get overweighted versus high PE stocks relative to their market weight. And he's right. And Arnott says, yeah, and value investing works really, really well, except for the last 5 years. So you can see all over the place, Arnott, my word, look how many blast Robert Arnott on factor timing, all these kind of things. So that would be the best way. You could probably find a YouTube of the two of them, but they're both exceptional speakers. Find them on YouTube, find them on podcasts. They're really, really amazing guys. I've met Arnott a couple of times. I've never met Cliff Hastings. That's fundamental weighting. That's an interesting approach. You might do that approach because it gives you something interesting to talk about in an interview. You may not agree with it, but at least it's sophisticated and new, so you're kind of on the edge. Once you figure out how you can put the portfolio together, then the question is, what do you do going forward? When do you sell? That's the most important thing. You might say, you know, we'll start our positions at 2%. But we can't keep it at 2% because they're going to move every day. But if a stock gets to 4%, we're going to sell it back down to 2%. That could be a sales discipline. Or you might have target prices. You say, I think the stock's worth 100, it's trading for 80. As soon as it hits 100, we're going to sell it. You can have, you know, I talked about, you know, we sell gains too fast and hold on the losers too long. You can have a process that say, hey, if a stock falls 10%, we're going to sell it and get out. And we obviously made a mistake. That could be your sales discipline. There's a lot of different ways you can do it. But their risk management is pretty important. Those are your hard and fast rules that keep you from making ego decisions. Keep you from selling your winners too fast. Keep you from holding on to your losers too long. That's your risk management. So those are the 4 pieces. Anybody remember the 4 pieces? Number 1, you have a philosophy, I believe. Number 2, your process of how you're going to find those stocks that meet your philosophy. Number 3, instruction. How are you going to figure out how much to put in each stock? And then number 4, your risk management. Yeah, right there gives you a good discussion for an interview. All right. Plenty of resources on the internet. Who knows which ones are good, which ones are bad. Your goal is you don't really care what works and not works right now. You just want to have something that sounds intelligent. Because what do you think 10 years from now you're going to think about what you think today? In 10 years from now, you think you're a genius today, you did something wrong. All right. I doubt anyone's at the top. Y'all want to be at the top of your game right now? 5, 10 years of experience. No, I was better in college. That would be pretty horrendous, right? Maybe Tim Duncan's okay with that, but that's because he's in a physical game, right? But hopefully 10 years from now, you're going to think, I remember our composition professor, he made us compose, we had to compose music like every 2 weeks. And he says, I don't care about writer's block. You're going to keep writing music. And he said, because 5 years from now, anything you write today, you're going to think it's garbage. You just got to get it out and do it. So just pick something and go with it. Pick GARP and just go with it. 10 years from now, you might. Well, it's in there twice. We need to talk about relative value analysis. So we've got 2 things left, relative value analysis and options. And I love options. So we'll finish relative next week and start on the next class and start options. That's the only 2 questions we have left on the exam too that you haven't done as a team case. Is relative value and options. So we're getting pretty close to having the entire thing. All right, we'll stop it there. It's almost the same formula 3 times. Something times a growth rate divided by discount rate minus growth rates. So cap earnings, we're going to use earnings. 1163 times inflation. Inflation's expected to be 2.5%. I give you the discount rate, so that's real easy. Minus inflation. Y'all got 216? That sound familiar? And then DDM, same thing, but we use earnings we use dividends, 504. For some reason I say normalized, so I might have made some adjustment. Long-term earnings growth, 4.5%. Divided by 8% minus 4.5%, 150. So here a firm where the DDM is less than CAPM. Why? Probably because the dividends don't reflect free cash flows. So that's a firm where you probably want to use free cash flow. And then the H model, same thing again, except for here, we're going to do dividends again, 5.04 times the H. What's the H in this case? 4. What's long-term growth? Short-term growth is 10. 4.5. You get 182.16. Those numbers sound familiar, hopefully. So
Took me like 1 minute, and it's a 1 minute question, so it's a pretty fast question. Just plug and go. It's a simple thing. Questions on that? That's like a gimme. Most students actually get that right on the exam. Some students struggle with parentheses. So just make sure it's not divided by the discount rate minus the growth rate. You gotta, you gotta divide by both. But they're pretty simple formulas. All right. I sent out an email structure survey. You do that. I do read those. So this class is unusual because I expect you to learn stuff, which is, not the norm in college anymore. So some students find that unnerving. So, whatever comments you give, the key is the students who do well in my class generally do really well in finance because I try to make my class look as much like a finance job as possible. I was talking to a student earlier. He's like, yeah, I'm about to graduate. I've never used CAPM. I've never used Bloomberg. Like, yeah, that's the problem. Because when you start your job, they're going to expect you to know that stuff. And so, yeah, if I were a freshman or a sophomore, I'd be in the Bloomberg lab every single day for an hour learning that stuff because that's what they expect you to know. So, so I'm trying to set it up that this class, like paper 3 and 4 should feel like an actual finance assumption because what did I give you? I didn't give you anything, did I? You don't have a risk-free rate, you don't have a discount, you don't have a market risk premium. You got to come up with all those numbers. How much does that sound like a job in finance? That's the entire job, isn't it? They don't give you anything. So you got to figure out where that data is. And if you're sitting there in your first job, you've never used Bloomberg or Cap IQ, where's the data? It's going to be embarrassing to say, well, where do I get the data? And say, well, you got Cap IQ, and you're like, what's that? That's going to be really embarrassing in your first job. So this student was panicking because he was graduating. I said, if you start now and you go 3 times a week and spend an hour in that lab, by the time you graduate, you're going to be where you need to be. It's not like you're 4 years behind. He just needs to start now. So how do you catch up? Well, one way to catch up is, if you're behind in a race, but you're standing, what's the first thing you might want to start doing? You might want to start running, all right? Are you going to, if it's a marathon, you're going to start sprinting? No, what are you going to do? You're just going to start running. That's what you got to do. You just got to get started. It's not, it's not like it's hopeless. It's hopeless if you never start running. You're not going to run a marathon if you never start running. That's going to be kind of tough. So, all right, let's do relative value analysis. One of 2 things we have left on the exam. This will probably be a team question on Tuesday. Relative value analysis is very, very, very important. I like what Dr. Motorin said. He used to not teach relative value in his class because it's like we don't use this in finance. And then he did a survey with the students 5 years, and they were all using it instead of what he taught. So he's like, okay, if 100% are using relative value and not using what I teach, maybe I should at least start covering it in my class. So I'm stealing a little bit of his stuff. I like the way he does it. But relative value analysis, it's one of 3 approaches we use in finance. You're doing one of the approaches in papers 3 and 4. This is the second approach, and there's a third approach you may not see too much in undergraduate. I'm going to give you real estate as an example because we just naturally do relative value analysis for real estate. And then what the Motorin said, and what I really like, a reason I stole some from him, he says, oh, fine, you're going to do relative value analysis, that's fine, but at least do it correctly. Okay? At least have the right factors and you're looking at the right kind of things. And then on the exam, you have to do 2 things. It's which price relatives are correct and which ones are incorrect. And then which industry goes with which price relative, all right? I think it's the easiest question on the exam, and it's the lowest scoring question on the exam. So there's some disconnect between my brain and what I'm doing here. So we'll see. When we do the team question next Tuesday, we'll see if I get some blank pieces of paper back. So hopefully by the end of this presentation, you'll understand it. So what are the 3 approaches? Fundamental analysis. That's papers 3 and 4. You're looking at the company, figuring out how fast it's going to grow, what's its growth rate, what's its discount rate, doing a discounted cash flow analysis. That's what most colleges teach and not the other 2. Technical analysis, that's charting and looking at price behavior, momentum, moving averages, RSIs, Bollinger, those kind of things.
I require one paper in my Superintendent's class on technical analysis. It's the easiest paper of all because I just want them to try it. If you want to learn technical analysis, the easiest thing to do is get on the Bloomberg and just type TECH, and all this stuff comes up. They have every single technical analysis thing you can think of, and as you click on it, they give you a definition of it, what it means. And if you type in a company name, they give you that technical chart. So if you want to see a Bollinger Bands sound really sophisticated, but they're really pretty simple. It's just a moving average combined with a standard deviation of the stock price, real simple stuff. If you want to see that, just click on the Bollinger Band and they bring it up. So technical analysis, you can teach yourself that real quickly. So we're going to do relative value analysis. You can do all three of these at the asset class level. If you're trying to figure out a small cap or large cap or the place to be, you can do a fundamental analysis. You can actually value them. You can do technical analysis, look at their stock chart. We did that at UTSA, technical analysis at asset leverage level. And you can do relative value analysis. What's the PE of the S&P versus small cap? You can do all three of those. You can obviously all do them all at the security level. So what is relative value analysis? You're taking some measure of value. We're going to see that there's two of them here, but we're also going to look at some non-values thing, whether it's earnings, price to earnings, sales, whatever. We did this in your class. You're seeing this again. You remember it? Could you do it again? Could you do this presentation? All right. So let's see if we can get some better retention in there. All right. So the two measures we're going to use is either price or enterprise value. So there's only two in the numerator. Price is pretty easy. That's the market value of the firm to the stockholders. Enterprise value is price plus the bondholder. So enterprise is all capital providers, stock and debt. Price is only the stockholder. Now, enterprise value should be higher than price. When I say price, I mean market cap, market price, market cap and price are the same. So you think if you're taking those stock value and adding debt, it would be larger, but it is possible enterprise value can be smaller because usually in enterprise value, they add debt and they subtract cash. Sorry. It's probably another spam call. I get like a million of these now. And they're all computers too. And they're doing a horrible job of making a computer not sound like a computer. Y'all notice that? And how long does it take you to tell us a computer? Like the first word, isn't it? So they're not doing a good job. All right. So enterprise value can be smaller. If you do a firm like Microsoft or Apple, which have debt but have a whole lot of cash, it's possible it could be smaller. So enterprise value is really you add debt, subtract cash. So when do you use price? When do you use enterprise value? We have to address that. And then you have factors. So the most common are earnings, revenue, and book value. So none of us have anything to do with market value. These are accounting measures, and we tend to use accounting measures. So you don't have to use accounting measures. So I like to look at Tesla's value versus how many cars they produce. That to me is a ratio you can use. You could look at, well, there's other ones that we'll see if you do kind of a factor model. So you can run a factor model. But the most common, we're going to use earnings, revenue, and book value. And then there are several industry-specific factors that you can look at. I mean, a good example is USA sold Victory Capital. The most common thing if you're looking at someone like Victory Capital, they probably looked at the price over assets under management. Because that's the most important thing for a firm like BlackRock or Vanguard, assets under management. So there's some industry-specific ones. So relative value analysis essentially accepts that markets are well valued. You can get a little concerned if the PE ratio is like 32 and it's normally 20, that might tell you it's overvalued. But we're generally trying to figure out if one thing's overvalued versus everything else, especially on the individual stock level. So Is something overpriced, underpriced? And we use the words that I don't like. We use the words cheap and rich. I wish someone had come up with better words than those. I like inexpensive and expensive, but cheap and rich. But someone comes up with the original number word and we're stuck with it. So if in an interview, you want to use the words cheap and rich. So, hey, yeah, man, NVIDIA is trading really rich right now. Makes sense with AI, you know, you use those words. You don't say it looks expensive. So let's do a real estate example. So you're looking for a house. All you know is that the house costs $150,000. You have no more information. Would you buy the house based on that? I'm hoping everybody's going to say no. Not much information, is it? Let's say the house in that neighborhood for $150,000. There's two other houses that recently sold, one for $875,000 and one for $675,000. Would you buy the house now? You would, yeah. Okay, some people might jump at it. If you say, like, you have 3 seconds to decide, and I'm just going to somewhere else and say, okay, based on that, I'm going to go for it. You might figure, yeah, maybe a really horrible house, but I could probably tear it down, build a new house, and sell it for $1 million. You know, who knows? I've been watching some of those remodeling shows. I watched the first 30 seconds and then the last 3 minutes. Some of those are pretty dumpy houses, and they look pretty nice at the end. But if you put 100,000 into it, and it increases the value 80,000, but you know you're in a pretty nice neighborhood, so maybe just the lot itself. But you could be in California. It could be one of those houses on the cliffs where the cliff is falling away. That may not be so worth it. So would you like a little more information? Well, what about revenue? What about the house price per square foot? This house, you can buy it for $75 per square foot. Those other two houses are trading for $250 and $225. So now what have we done? We've adjusted the value of this house for some fundamental, which is the size of the house. Now it's a little more tempting, isn't it? We still don't know if it's the house on the cliff about to come off, but we do know this house is trading really cheap. Now, when you see something's trading really cheap, your first question is why? Why is it trading so cheap? So either the person selling the house is not too bright, that's what you're hoping, or there's something wrong with this house. Which do you think is more likely? Something's wrong with the house, right? So that's where you start. Is what's wrong with this house? But at least now you have some pretty good information to know this house is cheap. Now you want to figure out why is it cheap. So let's bring in every factor you can think of. Supposedly there's a website out there that does this for houses, brings in all the factors you can think of and does a regression and gets a pretty high regression. I don't think I got everything, but I just pulled some things. So the size of the house, we somewhat did that with the square foot. Does it have a pool? To me, that would reduce the value of the house to me, but for some people, it would increase the value. Number of bedrooms, that may be pro or con, depending on, you might want more bedrooms if you have a bunch of kids, or you might want fewer bedrooms that are larger or whatever, but that might be part of it. Kitchen is real important to some people. I wish I had a much nicer kitchen than I have. I'm tempted just to tear out the dining room and make it one massive kitchen, but that could be part of your design. What is every one of those remodeling shows doing? More open, isn't that the thing now? They're tearing out all these walls, got this massive room. Probably 20 years from now, they're going to be putting walls up, who knows? Landscaping, how nice is that? How old is the paint job? How old is the house? The floors, the roof, the fence. I was amazed. I sold my mom's house. I bought it from her and then I sold it like 8 months later. We thought she was going to stay there longer. And the roof was in terrible shape. And I was shocked that we sold that house for. There's no way it was worth that. We sold it for like $550,000. They bought it for $175. I mean, that house was not worth $550,000. It was a horrible house, but that's Austin, right? All these Tesla people are moving there. But it had a horrible roof. My real estate person said, if you replace the roof, cost you $50,000, you could probably sell it for an extra $75,000. I was like, I don't want to do it. Just get the thing sold, so I didn't do that. Fences aren't that expensive, but that could be their garage could be an issue. Your generation may not even have garages. Y'all may be doing autonomous vehicles and you're just, who knows? So some houses today might look radically different. Quality of schools, some people think that's important. These are all related to value. These are all good things. But you also have to relate it to risk. Is it in a floodplain? Do you have any foundation issues? My parents' house had a major foundation issue. And there was damage to the house because of that, but it had been repaired and we had a guarantee. And I was thinking that guarantee is probably worth nothing because the guarantee is probably from a firm that's out of business, but I checked, they were still in business, doing well. So we had this guarantee. That was kind of nice. That if anything went wrong, they would fix it. That helped. I don't care. I don't know if you care about the nearest fire department, but that could be important. The neighbors, the quality of the neighborhood, that can be important. There's probably other things I left out, like in California, are you you're about to crash off the side? So whatever you can think of. Let's assume I got most of the things there. So this is really important. When you're doing relative value analysis, you need something on value and something on risk. If you leave out the risk part, you could be thinking you got this really great deal and you're just buying something that's about to blow up. So that's not good. And so if I put all those things into my model, and my model has a 91% R squared explaining housing prices, when I do that, this house should be trading for 150 bucks. And I can buy it for 75. Now it's really, really tempting. Assuming I have a good list. Okay, as long as I have a good list of what to look at, you're still probably asking the question, why is this house so cheap? Would you buy this house without seeing it? If you had all of this? Probably not. I wouldn't. But you're tempted, right? So this is a house you want to look at, and you want to look at pretty fast because you want to buy it really fast if there's nothing wrong with it. My realtor said the problem with my parents' house is the entryway. People don't like entryways like that anymore. It's wasted space. He said, okay, well, I don't care about that, but yeah. So most people, it has two rooms in the front, and the entryway is like, that's just waste. People want family rooms, they want kitchens. So yeah, maybe that's the downside to it. But that's the next question is, are there things on this list that are driving the value of this house that you don't care about? Maybe you don't care about the quality of schools because you don't have any kids. Maybe you're in a place that the schools just aren't all that good. You say, well, because of that, I can get it for 75. When, if they had good schools, it'd be go for 150. You're trying to look at that. And that's true with stocks as well. You might find that the market's really focused on one thing. And you're like, I don't care about that. I don't think that's important to the long term of this firm. So it's not just what this model tells you. This model tells you what everybody else values. You then want to ask the question, what do you value? Same thing with the stock. Let's say we could add two things to this model. Has anyone been murdered in the house? And is the house haunted or considered to be haunted? And when you do that, you can get your R squared up much, much higher than 98%. That's pretty good. And when you do that, this house now should only trade for 80 bucks. So obviously something horrible has happened in this house. And you're kind of worried about that affecting the value. But if you don't care about those two things, you got a really nice house, right? You take those two things out, the house should be trading for 150. You put two things in that you don't care about, you can get it for 80 bucks. And it's worth 80, you can get it for 75. So when you put these two things in, the house is a little bit cheap. When you take them out, the house is really cheap. You don't care about those two things. You're getting a house that's worth 150, you can get it for 75. That's pretty good. Except for what? What if you're only going to live there for 2 years? Then what is your problem? When you sell it in 2 years, people are going to care about those two things. If you're going to live in it for 20 years, you don't care. So if you're Berkshire Hathaway, you buy it, right? Because you're buying it as business. If you're a frequent trader, like Kathy Woods or whoever, maybe not, because you may need to sell it in 2 years. All right. So you always have to worry about what the market is asking, what they're focused in on. But there's some things you ignore if you're going to hold this stock for the long term. This is relative value analysis. We do it in real estate all the time. You have to decide how much you value each one of those things. So you might get a really, really good deal because the market's killing a house value because of stuff you don't care about. So same thing with the stock. So like ignores whether the housing market's cheap or expensive. It's just trying to figure out, is this house cheap versus all the others? So the key for good relative value analysis, you have to have the right relative value analysis. With housing, it's usually value of the house per square foot, price per square foot. And then you got to make sure you have fundamental factors and risk factors. And then those factors can be very generic, but as specific as you can get, the better. The more specific you can get, the better for your analysis. You are trying to get a high R squared, mainly to try to figure out what does the market find important. But once you figure out what the market thinks important, that's when you start making adjustments to say, hey, I don't care about that. These are the things I care about. So all three have to be there: the appropriate relative, fundamentals, and risk. Questions on that? It sounds a lot like statistics, right? Regression analysis. You have inputs. So this is essentially a factor model. You have inputs to try to forecast what the PE ratio is going to be. You run your model, see what your R squared is, and then you look at your company and see where it comes out. So based on all these companies, my company's, with all these factors, my company's PE ratio should be 20, but it's only 12. This is a really cheap company. Why is it so cheap? So we're trying to use those fundamental and risk factors as our independent variables to try to forecast the relative, just like we did with the real estate, number of bedrooms, square feet, all those kind of things to try to figure out the price of the house. High fundamental values should give you higher relative values. High risk factors should give you lower relative values. Now, this is a really important. I would be carrying this around my wallet if I were you. The value of the stock is the dividend discount model. It's its dividend divided by discount rate minus G. You just did that on the team question. How do we convert this into a PE ratio? Well, does this look familiar here? RF plus B times RMP, what is that? That's KE, what model is that? CAPM, there's your G. What is EPS times payout? Dividends per share. Yeah, earnings per share times payout is dividends per share. So EPS times payout is the dividend. Do you see this formula is exactly the same as that formula? So how do we get PE ratio? You move E over here. PE ratio. So this formula right here, what is a PE ratio? There's a massive amount of information in that one little formula. It's pretty amazing. A PE ratio is the payout divided by RF plus beta times market risk premium minus G. There's three things in there that are specific to the company, and there's two things in there that are generic to all stocks. All right, generic to all stocks is the risk-free rate. PE ratios are sensitive to interest rates. When interest rates are high, what's going to happen? If you increase the denominator, what's going to happen to your PE ratio? Higher denominator, you divide by more, what do you get? Get a lower number. Are PE ratios lower when interest rates are high? Absolutely. PE ratios were like 8. Guess what year PE ratios were at 8? When were interest rates extremely high? It's 1978, 79. Yeah, PE ratios were 8. Does that mean stocks are really cheap? No, interest rates are really, really high. Your discount rate and risk-free rate was extremely high. PE ratios. A few years ago, PE ratios were really high. Why? Because interest rates were really, really low. Right? Market risk premium, that affects all companies. When risk is high, what's going to happen to your PE ratio? It's going to be low. When people are worried about risk, PE ratios are low. In 2008, PE ratios dropped dramatically. Why? Because risk increased dramatically. All right. So in periods of high interest rates or periods of high risk, PE ratios tend to fall. In periods of low interest rates or low risk, PE ratios are high. That affects all stocks.
There's actually a little bit better relationship between PE ratios, not in interest rates, but inflation. There's a high correlation between core inflation and PE ratios. You can graph it and you'll notice periods when stocks were grossly overvalued, like in 2000 with the dot-com. If you graph PE ratios relative to interest to inflation, you would have seen those stocks grossly overvalued. So that can work pretty well. You can do PE ratios versus the VIX, which is a good measure of market risk premium, and you'll discover when the VIX rises, PE ratios fall. Then let's look at the three things related to the company. Beta is related, so we got fundamentals and risk. Remember, fundamentals and risk. Beta is related to risk. When a firm's risky, if the beta is high, what's that going to do to the PE ratio? Higher denominator, low PE ratio. So a stock can have a low PE ratio because it's very risky. It has a high beta. Why might it have a high beta? Well, because it has a lot of debt. Firms with a lot of debt have high betas. They tend to have lower PE ratios. You got to be real careful for that, because if you look at a firm and say, wow, Kroger's is really cheap versus other grocery stocks or other consumer staples, you might think they're cheap, and then you go look and say, wow, they got a lot of debt. Maybe they're not all that cheap. They may just be really, really risky. So you got to be careful of that. And then the last one, the only time we subtract is on growth. So if you subtract that number, if growth is higher and you're subtracting it, higher growth is going to give you a lower denominator. So higher growth means higher PE ratios. Just like I said before, if risk is higher, you get lower PE ratios. If fundamentals is higher, you get higher PE ratios. So if a stock has a high PE ratio, it's either low risk or high growth or some combination of the two. If a firm has a low PE ratio, it's either high risk or low growth. You remember earlier in the class, we talked about value stocks and growth stocks. Value stocks are what? They're either risky or low growth. And which are they probably? They're probably both. What is Macy's? Macy's is a value stock. Are they low risk? I don't think a Macy's is low risk. That's a high risk, right? Consumer discretionary. Are they high growth? No, they're a mall-centered store when malls are going out of business. So Macy's is both high risk and low growth. That's why they look so cheap. Do you want to buy a cheap stock when they're cheap for good reasons? Probably not. Walmart is a high PE stock. Why is Walmart high PE? Is it because they're low risk or high growth? And Costco is an extremely high PE stock. Is that because they're low risk or high growth? Probably more low risk, but for Costco, there may be some higher growth there because they've done really well in growth here recently. Now, one number I haven't talked about, and that's payout. We ignore payout. Why do we ignore payout? Well, remember on paper 4, you're going to do the sustainable growth model. Remember, sustainable growth says sustainable growth is ROE times 1 minus payout. So in finance, we assume a higher payout gives you lower growth, that those two exactly offset each other. So it doesn't matter. A firm pays out more in dividends, they have a higher payout, but they're not going to grow as fast because they pay out more. So we can ignore payout because we assume it just perfectly offsets growth. So that one you can ignore. So tremendous amount of information in that ratio. So if someone asks you a relative value question and you know this formula, you can talk a lot. You can talk about the impact of interest rates, the impact of the VIX, the impact of beta, the impact of growth. It's all in that ratio. It really defines what a growth and value stock is. Questions on that? So NVIDIA has a PE ratio of 118 times, Macy's is 5, Costco is 42, Amazon is 75. All right, which of these are expensive stocks? You can't look at that top part and just say they're expensive or cheap. So who's expensive here? NVIDIA, right? This is not a trick question. NVIDIA is expensive. Why are they expensive? Are they low risk or are they high growth? They're probably high growth. They could be low risk, but I don't know if I think of semiconductor stocks, especially going on what could go in Taiwan. I'm not sure. Which one's a cheap stock here?
Macy's, that's a really, really cheap stock. Think about that. You pay $5 for 1 year of earnings. If they can just keep their earnings where it is for the next 5 years, it gets all your money back in 5 years. That's pretty impressive. Not many stocks you can get all your money back in 5 years. Why is Macy's so cheap? High risk or low growth? Probably both. Probably both. When's the last time you were in a Macy's? When's the last time you were at a mall, other than maybe Lock and Terra? Do y'all go to Lock and Terra?
Yeah.
I don't know why outdoor malls are still popular. I go to Lock and Terra just to go to the restaurants. I've never shopped there. I used to go to the Apple store, but I haven't been there in a while. That's probably the only time I was go to the Apple store and buy a new Apple phone. And then that was the only time I went to Bed Bath & Beyond, because it's right next to Apple's. So I would have my phone at Apple's, go over and buy some smelly stuff at Bed Bath and come back and get my phone. So Macy's was kind of in that dying world of mall-centered stores. Costco is really expensive. I actually think Costco is overpriced. It's a great company. It's one of my favorite companies. Incredibly well managed, incredibly focused management. I love how they take care of their employees. There's so much wonderful stuff about Costco, but the market already knows that, and it's an expensive stock. I think it's overpriced. If Costco drops 50, 60, 70%, I might be interested in it, but if it does that, there's probably some reason why it did that. And then Amazon's interesting to me. It's not a particularly profitable firm, but they do dominate online. They do dominate in the cloud business. I haven't never bought Amazon stock. It just seems a little too good to be true. I'm kind of the same way I feel about Tesla. Great firm doing wonderful things. Boy, is it expensive, but you lose out on opportunities if you avoid stocks like that. So we're talking about cheap and rich. NVIDIA could be underpriced. 118 might be too low, and maybe they should be higher. Maybe they're much higher growth, but who knows? Do you think the market tends to get too optimistic and too pessimistic? Do you think the trend shows that a firm like NVIDIA, they probably should be much higher than that? That's what you have to figure out. When a stock gets that expensive, I mean, it's going to take you 118 years to get your money back if they don't grow their earnings dramatically. They've done it this last year, so who knows? We used to own NVIDIA, but we haven't owned it in a while in our student portfolio. So the numerators are current price or enterprise value. This is the exam question. So now we're into the exam question. I think this is so easy, but for some reason, students struggle with this. So let's see if I can do better this time. When you're looking at price, there's only one group that gets price, and that's the stockholder. Price belongs to the stockholder. The market cap of the firm, the market value of the firm, that's the stockholder. Right? Do y'all see how price and market cap are the same thing? Price is the individual security, market cap is individual security times the number of outstanding shares. So price, that's only stockholders. Enterprise value is the stockholders and the bondholders. So that means when you do a ratio, you got to make sure if your numerator is only stockholders, you got to make sure your denominator is only stockholders. Then you got to make sure if your numerator is stockholders and bondholders, you got to make sure your denominator is both stockholders and bondholders. All right, that's the critical piece. So let's look at our denominators. Earnings per share. To whom does earnings per share belong to? Is it stockholders or stockholders and bondholders? So what belongs to the bondholders? What do they get? They get interest. Is earnings per share after interest expense or before interest expense? It's after. So who owns earnings per share? Stockholders. So it's price earnings. It's not enterprise value to earnings, it's price to earnings. Okay, so PE ratios are fine. What about EBIT and EBITDA? Who owns that? Both. Why? Because it's before interest. I've heard students say EBIT is earnings before income tax. That's not correct. It's earnings for interest expense and income tax. Okay, the I is for interest expense, T is for taxes. So EBIT is before interest expense, so that belongs both to the stockholder and the bondholder. So what would you use for that? Price or enterprise value? enterprise value, right? There's no such thing as price to EBIT. There's no such thing as price to EBITDA. It's enterprise value to EBIT, enterprise value to EBITDA. Book value, who gets book value? Book value is assets minus liabilities. Sounds kind of obvious, right? You subtract out liabilities, what are you subtracting out? You're subtracting out all the debts. So who owns book value? Stockholders. So which would you use there? Price to book. There's no such thing as enterprise value to book value. That doesn't make any sense at all. So price to book value. What about revenue? Who gets revenue? Is revenue before interest expense or after interest expense? Before. So who owns revenue? Both. So what ratio you use there? Enterprise value. All right. If you go to Yahoo Finance, so Yahoo Finance has the PE ratio on the first page. Walmart's at 30. That's pretty high for Walmart. But if you do statistics, and we saw statistics for the PEG ratio, you do the statistics, Yahoo Finance has one error on their spreadsheet, on their page. What's the one mistake they made?
Forward.
Forward PE is fine. So forward PE is, trailing PE is price, today's price over the last 12 months earnings per share. Forward PE is price over future earnings per share. That's fine, you can do that. Price to sales, that's absolutely wrong. If you pick companies based on price to sales, you're going to find a company that looks really cheap. You might find out they're not cheap, they just have a whole lot of debt. And you're not going to notice they have a whole lot of debt unless you subtract interest expense or you subtract the debt from book value. Why they have that on their page, I don't know. Someone messed up there. So you never use price to sales. The others are fine. The PEG ratio is fine. That's PE ratio over growth. Price to book is fine. Enterprise value to revenue is fine. Enterprise value to EBITDA is fine. Those are all fine, except for price to sales. So on the exam, I might give you price to EBITDA. And when you see that, what are you going to say on the exam? All you have to say is, do you keep that ratio or do you kick it out? Price to EBITDA. So you say kick it out. That's price to EBITDA. Price belongs to stockholders. EBITDA is stockholders and debt holders. You're mismatching your capital providers. All right, pretty straightforward. What if I give you enterprise value to book value? What do you do there? You keep it or kick it out? Kick it out. Why? Enterprise value, stockholders and bondholders, book values only stockholders. All right. So that's the first part of the exam is which of those ratios do you kick out because you mismatch your capital providers? The second part of the question is once you figure out which ratios work, what's the best ratio for your particular industry that you were in? Okay. So there's two parts of the question. And it's not a multiple choice. You don't circle the right one. You have to tell me why. All right. So really important. So it's important you match your capital providers. If your numerator is both, your denominator needs to be both. If your numerator is only stockholders, the denominator needs to be just stockholders. So these are all the ratios that work. Price to earnings, EV to EBITDA, EV to EBIT, the PEG ratio. Price to book value, one I really like is price, not the book value, but price to like 10 years of earnings. Robert Shiller is famous for doing that with the CAPE ratio, but yeah, price multiple years of earnings. So you might have an industry that price to book value is the best ratio to use, like a Boeing. You want to use price to book value, but their book value is negative. It's like, well, how do I value Boeing price to book value if they don't have a book value? Well, instead of using book value, you can just get 10 years of their earnings and do price to that 10 years of earnings. Because what is book value? Book value is the firm's earnings since inception, minus dividends, minus stock buybacks. So essentially what you're doing with book value is you're trying to collect many years of earnings. Well, you can just do that yourself, just collect 10 years of earnings. And I think Bloomberg may actually have price to 10 years of earnings as an available one. And then last one, EV to sales. So when do you use which of these ratios? All right, let's look at that. I think it's pretty simple too. You just have to kind of memorize this. So earnings-based relatives, price to earnings, EV to EBITDA, EV to EBIT, PEG ratios. That's when you're really focused on growth. Those are those high growth companies like technology, semiconductors, communication services. Those type of firms, we almost always use EV to EBITDA. So NVIDIA, EV to EBITDA, that's what everybody's going to go to first. Okay. Maybe a tech company or communication services company. So NVIDIA, Meta, Google, or Alphabet, those type of firms, you're definitely going to be using an EV to EBITDA. It's the most popular, or a PEG ratio to be popular as well. When do we use book value basis? Well, there's three industries we do that for. The first one are those firms that have high capital requirements. And the way I look at this is I go on Yahoo Finance and I look at their property, plant, and equipment and see how large it is versus their assets. So if their property, plant, and equipment is like 10% of assets, they're not in this category. Their property, plant, and equipment is like 60% of their assets, then I might include them in that category. So utilities, utilities have massive amounts of property, plant, and equipment. Manufacturing firms have a lot. Now, there are some firms that may be a little tricky. So Intel is a good example. Intel is definitely tech, but they're also fabricating semiconductor, which means they have a lot of property, plant, and equipment. You could conceivably use price to book for Intel because they have so much property. They have a lot of investment they have to do. Those fabrication plants are like $1 billion investment. They're extremely expensive. So if it's possible, you could do either one of those. Utilities are always going to be price to book value. Although there's a better ratio for utilities than price to book value. It's called price to, well, it's actually EV, the regulatory assets. But if you're not sure, if you can't find that, price to book is the most common one. The second category are cyclical firms, like energy materials, firms that are very sensitive to some commodity price, like oil prices or gold prices or silver prices. Those firms, their earnings are going to just go up and down with the price of whatever they're selling. And so when oil prices are high, Exxon looks really cheap. And oil prices are cheap, Exxon looks really expensive. And you don't get tricked by that. So what you do is you look at price to book value, so you kind of spread out those earnings cycles. And that's where a price to 10 years of earnings can work really, really well. You're trying to get through the entire cycle. This is somewhat where emerging market stocks. I remember talking to an emerging market stock manager, and he said they use price to book all the time because the emerging market countries tend to be much more cyclical than others. So if you use price to earnings, they may look cheap, but they're just at the top of the cycle. Or they may look expensive and they're just at the bottom of the cycle. And in that case, that may be the best time to buy them is at the bottom of the cycle. So cyclical companies work really, really well. I would probably use a price to book for Exxon. Any materials company, price to book. If you got a steel company, price to book is the best place to go. And then the third one are those that are focused on return on invested capital. Banks, insurance companies, real estate companies, price to book value is the place you want to be. Banks always use price to book. It's the most common ratio. Insurance companies always use price to book. It's 100% of that. If USA sold off their investment arm, but if USA sold their bank, which they probably should, that's their Achilles heel, is their bank. They would sell it based on price to book. They would probably look at Capital One, which is their most common equivalent. Look at what Capital One's. They may bring in 10 banks, look at their price to books, and see where they're trading, and try to figure out what they could get for their bank. Their bank's probably higher quality, even though it's had some blowups here recently. It's probably higher quality than others, but Capital One, I can never remember their ticker. COF. I can never remember what, I knew it was CO, but COF. So their price to book is 0.68, which is amazing. Because book value is what the accountants think it's worth. The market value is what the stock market thinks. Now, accountants, GAAP accountants, they say accounting is supposed to be conservative. Doesn't look like it's conservative, does it? If you can buy the bank for 32% cheaper than what the accountants say it's worth, that looks pretty, I mean, let's look at NVIDIA. What do you think NVIDIA's price to book is? I bet it's not 0.68. It's 47. You buy NVIDIA, you're going to pay 47 times more than what the accountant thinks the company's worth. But for this bank, it's only 0.68. Do you think USA would sell its bank for less than the book value? Bet they wouldn't. Now, is that normal versus Cersei or abnormal? Do you think that's normal? What do you think what was my normal number during my career for a bank? Any guesses? A normal price to book during my career. Up until 2008. It changed in 2008. Any guesses? 1, 2, 3, 4. What would you think? No guesses? The 2 was the norm. A bank below 2 was cheap. A bank above 2 was expensive. Ever since 2008, they've been well below that. What do you think Citibank is right now? Any guesses? Any guesses? Kyle's going to look it up. Less than half of their accounting value. You can buy Citibank for less than 50% of what the accountants think it's worth. What are the accountants getting wrong? That implies there must either be some assets on Citi's books that are grossly overvalued or some liabilities that are grossly undervalued. That's a really cheap bank. If I saw that number in like 2006, I mean, say, man, is Citibank about to go out of business? What's going on? That's really, really strange. So 0.42. What about an insurance company? Here's an insurance company, 0.36. Really, really cheap company. We can even do maybe a little bit better one, maybe Met. Met's probably a much higher. Met's over 1. Why is Genworth 0.3 and Met's 1.56? Is Met overpriced? It's really strange right now. And financials are going through a strange period. What do you think JP Morgan is? Over 1? Do you think they're over 1? No, all right, you might be surprised. So they're over 1. They haven't been in 2008, they all dropped dramatically. And that's because people thought their assets, especially their mortgages, were gross overvalued. What about Frost? Over 1, below 1? What does Frost have that the market loves? They have one thing I think I mentioned earlier. We just changed my church from security service to Frost. I really love Frost. So they have a very, very low loan to deposit ratio. They dominate the industry. So the market tends to like them. They're even trading higher than JP Morgan, 1.8. They're somewhat of a takeover candidate. If you think about Goldman Sachs is desperate for deposits, and they could just buy Frost and suddenly have these massive deposits and not have to pick up a loan book. Frost is a very unique bank. Does it make sense? Look at there. They're over 2. It doesn't make sense. Frost is more valuable than JP Morgan on a relative basis. Yeah, when you have that kind of loan deposit, it gives you a lot of freedom as a bank. It means they could do a lot of stuff that, you know, if the economy is turning around, they could do some stuff. They have some dry powder. So that part of the market is a little unusual right now, but somewhat because of 2008, they kind of shocked them. So you can buy Citibank really cheap right now. I'm not saying you should, but it's a lot cheaper now than it was in 2006, 2007. All right, so banks, insurance companies, real estate companies. And then revenue base is simple. Retail, use EV to sales, always. Macy's, Walmart, Costco, whoever, it's EV to sales. Would it maybe change, say, with a Carnival Cruise? Carnival Cruise, what 2 things might you be debated on front of Carnival Cruise? Is it a tech company? No, so where would your debate be? Maybe price to book, right? Because they have these massive ships. EV to sales is probably what it's going to be, but price to book would be a contender. Would you ever use price to book for NVIDIA? No, 47, it doesn't even mean anything. It's just completely meaningless number. So, all right. So if I give you a retail company, it's going to be pretty obvious. Use EV to sales. It's always. All right. Let's see if y'all can remember that. So Packard, manufacturing firm, builds diesel engine trucks. What would you use for them? Price to book. All right. Prudential life insurance company. Price to book. It's the financials. Let's see if I can't think of companies. Microsoft. EP to Microsoft. EBITDA, EV to EBITDA, probably EBITDA. Why not EBIT? Why not price to earnings? Dr. Demoterin says it's because finance people like to say EBITDA. Sounds cool saying it. I don't know if that's the reason or not. I think it's, and I think he mentions this as well. Price to earnings is going to give you the highest number. EV to EBITDA is going to give you the lowest number because EBITDA is a lot larger than earnings. So I think one reason people like to use EV to EBITDA is they like to tell their boss, this stock's only trading at 15, where its PE might be 30, its EV to EBITDA is only 15. It's not really cheaper, they're just using a different ratio, but they still prefer to tell their boss 15 instead of 30, just because it doesn't sound so outlandish, but that might, there's some psychology here. So let's see, I think I mentioned some of these. Okay, McDonald's. EV to sales, EV to revenue. Yeah, McDonald's, I would definitely do that. So, I mean, that's the kind of things you're looking at. Now, when you get the EV, the revenue, one thing you got to be careful of, and let's see if I can figure this one out. So, I can think of one that's actually trading. Boy, I don't know. What's a good luxury brand?
Rolex.
Who?
Rolex.
Rolex. All right. So Rolex. Rolex versus Costco. Who's going to have the higher EV to revenue? Who's going to look more expensive? So who has massive amounts of revenue between those two? Costco. So what's that going to do to EV to revenue? Make it really, really low. So Costco is going to look really, really cheap. But are they really cheap? Well, what do you know about margins between those two? Yeah, firms with massive margins are going to have really high EV to revenues. Why? Because they get to keep more of their revenue. So if you look at the EV to revenue, one thing that better be in your model is margin. You better have gross and net margins, because if you don't, Rolex is going to look real expensive and Costco's going to look cheap. But then when you bring in Costco's 3% margin and Rolex's 30 or 40% margin, you say, yeah, I'm willing to pay more for them. All right. So once you look at these, you can't just look at that. You have to bring in those value things. So you got to adjust it for the margins. So that's why you need a model to look at these things. All right. So how can you use these? It's for screening. So I recommend we have videos that show you how to do this. I'll show you one of the models today. You can watch my video and you can build one yourself. If you've never done that with Bloomberg, make sure you do it before you interview with jobs, because it's really easy to do. The video I'll show you how to do it is less than 30 minutes. You can build an entire model in less than 30 minutes. It's pretty simple to do. I've never tried this myself, but you could probably do this same type of thing with bonds, but looking at CDS spreads or those type of things to try to value. So it may be possible to try to figure out what bonds are mispriced doing that. You can use it to value a non-publicly traded company, just like I talked about USAA. If they want to sell their bank, you would use a price to book and probably bring in 10, 20 companies and try to see where they could probably sell that bank. You can use it to determine benchmarks for a company. I did this at USAA. I brought in all of the insurance companies I could find, and I did this type of regression analysis. And I was trying to figure out, there is more the debt side. I was trying to figure out why The question I got was, why was USA's life insurance company not AAA rated? It was only AA rated. And I did all the analysis because their capital ratios are really high. They're really well capitalized life insurance company. Like, we should be AAA. I did the analysis and I said, yeah, the analysis shows it doesn't matter what your capitalization is. But then I changed the analysis and I stratified it by company size. And what I discovered is big companies with high capital ratios were higher rated than big companies with low ratios. But small companies with high capital ratios, the size was the most important thing. Big companies got higher ratings than small companies. When I told the life insurance company, the only way you can become AAA is you got to quadruple your size overnight. And they're like, we can't do that. So they're kind of stuck with their AA rating. So you can do that kind of analysis. It's pretty impressive. If you're working for a firm and they want to know, hey, why are we trading at a 20 PE? All our competitors are trading at 20 PE. You can run this analysis. You can say, hey, it's your gross margins. Your gross margins are just not high enough versus your competitors. You're not charging enough or whatever. There's something going on. So you can do that. It's pretty easy to do. And then the last thing you can do is just figure out what is the market focused on. What type of ratios do they think are most important to the value of the stocks in this particular industry? And there's two ways to do it. You can do a regression analysis, which I don't recommend. I saw the motor end do that, and it was real exciting. I said, wow, that's pretty cool. I can do that. And then I tried it, and it doesn't work. And the reason it doesn't work is you run your regression analysis, this multi-factor model, and you get these slopes, and you get this high R squared, 89%. You're like, wow, that's really good. And then you look at your slopes, and you discover that the slope on debt to equity is positive. And you think, wait, I'm not going to pay more for firms that have more debt. That doesn't make any sense. And then you look at your turnover, or you look at your margin, and the slope is negative. Say, I'm not going to pay more for firms that have lower margins. And so every time you run the model, you have one slope that goes in the wrong direction. If you have that problem, you got to kick it out. If you know you're not going to pay more for firms with more debt, you got to throw the entire model out. And so then I said, okay, well, I'll just take that factor out and I'll rerun the model. And guess what happens? I'll rerun the model and another slope changes and it's the wrong direction. And it's just too frustrating. So what we've done in the investment society is we started building ranking models, which is what I did at USA as an analyst. I just didn't have the technology we have today to do it as fast as we can today. So what we do in ranking models is we bring in all the factors and we rank the company on all the factors. If the slope's going the wrong direction, it just allocates 0% of that factor and just completely kicks it out. And so it works pretty well. So let me show you some examples, because my secure analysis class, we just did this. I have a video out there in that class where they run the entire model, but they start with an existing model. If you want to do that, email me and I'll send you that model. I think Alec, you saw that, right? And Cody's here. So you can try it. The video is only 15 minutes, so you have a good starting point to go. It's pretty easy to do. Bloomberg works pretty well. I don't know which one I want to do. I'll do this one. Oh, that's not it. Sorry. That's another good model. Consumer staples. Oh, that says macro because Alec built, I should show him your macro. Alec built this really cool macro. So how many of y'all can build? These are basic macros. I used to do those all the time, and boy, I've gotten so rusty. He's asking me if I trust your macros. So, all right, so what you do is you bring in all the companies. I have 148 consumer discretionary companies. 148, that's a pretty good measure. In all different industries. And I bring in things related to turnover, like asset sales growth, asset turnover, working capital. I bring in things related to margin, gross margin, their net margin.
I bring in things related to return on capital, and I bring in things related to risk. So I got all of this data from Bloomberg, and this is what a Bloomberg formula looks like. BDP, Bloomberg data point. I'm getting error messages because I'm not on a Bloomberg machine. You get on Bloomberg machine, it brings all this data in. So I have I have 3,700 pieces of data. It took me 7 seconds to get 3,700 pieces of data. Y'all can see why I didn't do that when I was experienced. We had Bloomberg, but it wasn't tied to Excel. So if you wanted data out of Bloomberg, you had to write it down and go type it into Excel. So now you can get all that data in just a nanosecond. Same thing with Capital IQ. You've got to know these databases. You can't sit in that first finance job and not know where the data is, but start training yourself on this stuff. The next thing we do is we then rank them. Where does that first, this is Guess. When's the last time you bought something from Guess? What is it, Blue Jeans or something? I don't know what Guess sells. Has it been a while since you bought anything from them? So their sales growth, they're 110 out of 158 firms, not a high growth firm. Their turnover is not very good either. Their capital management, they're pretty good at that. Their gross margins are kind of middling. Their net margins kind of above average. So we've ranked them each one of those. And then we do a weighted rank. So you take each one of those factors times some percent and you get a weighted rank. So their weighted rank is 77. Who's number one? It's always been Monster in the past, but I don't know who it is right now. I don't see a number one. There it is. Let's see who's number one. Winmark. I have no idea who Winmark is. Specialty build. I'm not saying go out and buy Winmark, but they're the best stock in the model right now. Oh, by the way, they're also the most expensive stock. Looks like our model is working pretty well, doesn't it? We think they're the best and the market having the most expensive. That's what those two columns are. AU is what we think their rank is. AD is their actual rank. So what are we looking for? Would you want 50 and 2 or 2 and 50? 2 and 50, right? You rank it number 2 and it's the 50th most expensive, right? That's what we're looking for. So would you buy that stock? That sounds like Costco, doesn't it? Great company, too expensive, or at least perfectly priced. So what are we looking for? I kind of like this company right here. It's 35th overall, but it's the 58th most expensive. So if you chart all these out, up here are cheap. These are the ones that are cheap. So up is cheap, to the left is a good company. So there's that Winmark. They're number one and number one. Here it looks like a good company. We rank it 21st, but it's the 41st most expensive. Wouldn't you love to walk into an interview with that chart and just say, hey, have you done any model? Yeah, I have my own model. Here's how we do it, and give them the chart. What percentage of undergraduate students would do that? Somewhere below 1%. I know, pretty low number. And it takes you maybe 30 minutes to build a model like this. Does that look like it has a high R squared? You don't see any stocks like way over here, do you? We think it's the best and it's the 180th. You don't see any over here like we think it's the worst and it's the most expensive. Why is that? Because we cheated. We kicked out the outliers. We did have a few like that. One thing on staples that we always pick out are the online education companies, because I don't like them. I don't trust them. They look really cheap. They look really cheap because I don't think they do a good job. I don't like University of Phoenix type of companies. So we take that cluster and we just kick them out of the model. All right. So I would challenge you before you and if you want to come up during a winter break, I'll open the Bloomberg lab. You can come in here for a few hours, teach yourself how to do this. You need to get stuff like this on your resume because other students don't. Right. So it's really, really critical. Pretty powerful stuff. You can do it really fast. It's easy to learn. You can watch my videos, teach yourself how to do it. So, all right, any questions on that? And thanks, Alec, for building the macro. And it's a pretty short macro, right? It wasn't like 80 lines long. It was pretty straightforward. All right. So we'll do a team question. You have the example on the video, right, that you can watch, so you can practice a little bit. And then all we have left after that, I will be here next Tuesday, and I think we have 2 classes after that. We're going to be doing options, which is my derivatives, my favorite topic. So we'll be getting into that. All right, we'll stop it there.